What's up, Outliers? Welcome to a new podcast episode. This is actually Shreyj's brainchild. We were talking in the community about different ways to convey information, and Shreyj had the idea for this podcast, which we're calling Outlier Trading Unfiltered. The goal for this is to try and explore topics of interest to the community, whether it's stuff that we recently covered, something that the community is struggling with, trying to work through, that we think is beneficial for just broader folks to be aware of, to think through themselves. The reason why Shreyj is such a good fit to do this is actually because he's been in the community essentially since the beginning. So he knows the way that I think and the way that I do business very well. And he's also familiar enough and more temporally proximal to the new trader journey, which, as a lot of you know, I literally started in 2007. I've been doing this for nearly 2 decades. I definitely remember some of the aspects of when I started, but I'm under no false pretense that I somehow completely understand the paradigm of like the beginner trader today. So I think he will be super useful in helping bridge that gap, because sometimes when I'm explaining something or talking about something, I will think all the dots are connected, we're at a good point, and this topic is well discussed. And in my own ignorance, I'll kind of forget the point that in that conversation or in that thought line, there might be several things that I'm taking for granted on the other side of the equation. And the other trader might be like, yo, what is implied volatility, right? Like something that simple. Like I take that as granted, but it might not be. So first of all, Shreyj, welcome on again. It's been a while since we did any sort of video together, but I'm super, super stoked to do this with you, to chat. And I think it'll be genuinely really, really useful for people. So thank you for doing this. And then also thank you for recommending the idea, because this wasn't on my radar, but we can make things happen. So welcome on, man.
Thank you. Thank you a lot. I'm really happy to be here. Thanks for having me. It's always a blast chatting with you. I really enjoy it. But before we get to the main topic, I actually wanted to take a few minutes, dive into some of the market updates from this week. Did anything from banks' earnings that have reported so far catch your eye?
A couple things. I think in general, the health of the consumer is still profound. I also think that you're getting a glimpse as to how effectively the banks are going to be able to navigate the lower rate environment, because you can see that across the board, a lot of the banks are beating, right? So if we look at Bank of America, they did okay. Even Goldman Sachs, they had a gap up. They did okay. So you're also seeing it across different size banks, different general leanings for the banks. Wells Fargo, apparently they were able to open up a bunch of fake accounts for people. So they absolutely crushed it. You never know with those guys if it's actually good earnings or not, but so far it looks really good. I think the financial sector has just been displaying unmitigated strength. That's what continues to stick out to me at the sector level. And then you can see it across the subsectors. I think the most interesting thing is definitely charge-offs, and seeing the difference between commercial level charge-offs and consumer level. And the consumer is still strong. And I think a lot of people haven't really expected that, at least up until this point, because it's been kind of a challenging environment for a lot of people, especially if you consider stuff like the average mortgage payment as a percentage of disposable income. If you've taken a mortgage out since the rate environments have been up, it's way higher. That's not easy on people. Yet they're still finding ways to engage essentially across everybody, offer different terms, offer ways to lower down mortgage rates and whatnot. So overall synopsis of all of that, robust. That's what strikes me. The financial sector looks really robust, and the deregulatory environment with Trump, I mean, you could see that just bleeding through. That's why we saw one of the initial moves in financials when Trump had won. And I think that that's just continuing to play out.
Yeah, I think I'd agree, particularly in the big banks, the ones that do the investing business, investing banking business, they're racking up fees. Big Morgan Stanley, JP Morgan, GS. There's M&A activity going on, IPO activity that they are exposed to. So generally good revenue. They're continuing to generate more assets under management from both the asset and wealth department. So even like you mentioned, the consumer-facing banks are actually doing well as well. The consumer doesn't seem that stressed, at least from the reporting that they have been doing. Wells Fargo somehow had an opportunity to drop off the net loan charge-offs that they're doing. So they're being able to get away with it. So I guess they have more money to invest or back up more bank accounts. So we'll see what happens. But from last week, I was particularly interested in Delta Airlines earnings. I don't know if you caught that. They were talking about expanding the premium offering, premium seats, and that is a sudden shift in how things are done in the airline industry. Usually, it would be cramming as many number of people, like building up units, like how we talk about, right? Just getting the revenue from that. But now it seems like they're expanding their offerings, doing upgrades within existing airplanes, retrofitting them, and ordering new planes with larger number of private or premium seats. So, yeah, really interesting economy where they're able to see that there's a section of consumers who can pay more and higher margin, generate higher margin from that.
The interesting thing about that is in environments like this, especially the higher rate environment, the unfortunate reality is those of us with money just get more. That is how it goes. It's shitty to say, but that is the reality. And I've talked about this, like not only just my own trading returns, but the last few years have been my hands down most profitable since I've started this whole thing. And these kind of environments help a lot. So it's one of those really nasty dichotomy of just human existence, where those with this kind of environment, it actually doesn't really hurt that bad. And in some ways, it's quite beneficial. And then those without, they're just punched twice because now they're just trying to make ends meet and shit's more expensive, and like definitely feel for that group. So the reason why I make that point is I actually had in one of my notes from like 3 years ago, I do like outlines on some themes that I think are going to happen with different industries broadly, just out of curiosity. And one of the things I literally talked about was premium airlines. I actually think that this might be the beginning. I think that you might find that there could be flights that are not on 747s, but slightly smaller planes, but are a kind of a gap between private and commercial, because there's an appetite for that. I think the airline industries have been so interesting because they're a product of what consumers wanted, right? Consumers themselves were the ones saying like, we want cheaper tickets. We want cheaper tickets. Well, what do you think comes with cheaper tickets? Smaller seats. You're going to get one thing of peanuts if you're lucky, right? Like that's what makes cheaper tickets. Now, again, I'll always make the point. The CEOs always seem to be doing okay. So I don't think their margins are quite that bad. The CEO compensation for these things is tens of millions a year, which is insane. So yeah, I'm not sitting here saying like, woe is the airlines. They're doing all right. But that is a byproduct of that pressure and that preference for the consumer of things being cheaper. But I think exactly like we were kind of talking about a little bit earlier, we absolutely are starting to see that there is definitely appetite for the higher end consumer for a different experience. And I'll definitely tell you from my own, like the first time you fly even first class, it changes. Like it changes a lot because you no longer dread getting on the plane at all. Like you know that you're going to have a spot for your bag above your head. So you never have to play the game of like, oh, I don't want to check a bag, so I got to make sure I get on my seat quick so I have a space for my bag. That goes away. And you're in like genuinely comfortable seating. So when you're on a 10-hour flight, 15-hour flight, even the lie flat seats, like that's a game changer. So yeah, I think for people that have the ability to travel in any version of those levels, it's typically really, really nice compared to the alternative. So yeah, I imagine the demand for it will actually continue. And it wouldn't surprise me to see these hybrid spin-off like offerings at some point. I don't think it'd be for a while, but at some point, because margins for airlines aren't that great, all things considered.
Yeah, makes sense. I'd agree. I do see that the potential part for them. Cool. I thought I'll give a little bit of introduction to myself since it's been quite a while I've been on the channel. So well, as you described, I've came across your channel about 5 years ago. I'm an engineer by training, but I'm a trader at heart. I accidentally came across your channel on through a Reddit post. In fact, the post was talking about the nuances of covered strangle versus the wheel. The comment section of that post was on fire. They were sending you to the nether realm. It was like Mortal Kombat out there. I was like, this guy is not that bad. He's trying to teach us something important here, this value here. So that's how, I came to visit the YouTube, and I've stayed there since. It has been really five years. It's difficult for me to comprehend all that I've learned during that time. But the first two of those years was just me. I think this would be helpful for people starting out in our community now. The first 2 years of it was just deep diving. I was immersing myself in the content. You kept putting out so many videos after video. There's so much to learn, and I kept just watching it, rewatching it. And then slowly, after like maybe 6 or 7 months, the good thing about me was I did not have to unlearn bad trading habits. So I was a clean slate that helped me to, pick up information at the right point. So that I'm really fortunate that way. I was mostly a buy and hold investor before, getting interested in trading. So I used the 2 years to mostly learn about what you're talking about. Why does this dude keep saying process all the time? Just tell me how to make the money. Why does he keep saying the process? What does he mean by that? So I had to understand what that is. So I started building logs. That's where I started. After watching the videos, then I made a trading plan, a trading log. And then in like halfway through the third year is when I had enough confidence to deploy cash in real markets after going through paper trading for 1 year before that. And since then, I've just been doing it. So I wanted to talk about that a little bit because people always want to rush in to deploy cash in the markets in real time. Little work is done trying to understand and prepare and just practice. There's no patience. It's difficult. Obviously, we need to get to where we need to go fast. And that's hard for in an environment like markets where there are no rules, no boundaries. We can get slapped quickly. So more than anything, I just wanted to take this opportunity to thank you, particularly for showing the path and then hammering it into our heads that we can do it, not just and then giving us the tools to walk that path, and creating a space like the Outlier Discord. Back when you created, I think it was called the Outlier Dojo. That's still stuck in my head. I still think of it. I'm very protective of the community and also feel very passionate about it. So, and I've mentioned this to you several times back and forth in email. So I think of it as a dojo. It's good people trying to work out their, the skill there. So yeah, I just wanted to thank you for that. Appreciate that.
Yeah, no, I really appreciate it. And I think that the context that you share is absolutely hyper relevant. I can't imagine many people out there that started trading, immediately had everything line up against their expectations and things go the way that they want them to. And there's one thing you said that actually really stuck out to me is that, you can kind of get slapped down pretty hard in the market. And the first thing that popped in my mind is the irony, because I think the worst scenario is actually when you get slapped down slow. Because the markets they're extremely deceptive. It's not like doing something like surfing or even shooting, which is a hobby of mine, or jujitsu or any sort of martial art. Or basketball or anything, right? Like when you do these other things, you get immediate feedback. If I shoot the ball and I miss, there's a problem. I know I need to recalculate because the end goal of that ball going in didn't happen. If I'm in jiu-jitsu and my goal is to strangle somebody and I wake up from a nap on the mat, I've made a grave error. If it was another scenario, I would be dead. So I now need to understand in that exact moment what went wrong, and you were so close, flash to bang, right? Like you're still there with the person in the situation. You can rework what happened, work a defense so that you're not prioritizing getting hooks out with both your hands and leaving your neck exposed so that you get strangled. It's complete opposite in trading. In trading, you can do everything wrong and you can make money. And you can make money for some time. And that's the concept of path, just how things happen to happen. The real nefarious part of that is it can really trick people into thinking like, oh, what I'm doing is working. I should size up my trades. It's working. And sooner or later, the performance will approximate to the skill. And at that point, unfortunately, the skill just isn't there yet. And that's normally when things go absolutely catastrophic for people. Rather than just losing a few bucks, they make some money on some trades over a couple months and they think like, oh, damn, like I really got this down. Let me start sizing up. Something happens. And all of a sudden they realize that, yeah, oil can go negative. Not something most people think about. But if you, in that example where maybe long oil, you're like, oh yeah, I'm going to get super, super long oil here at $1 because it's not going to go negative. And then all of a sudden it goes negative and you sized way up because you didn't think it could go below $1. Then all of a sudden you're like, oh shit, now I have a margin call. Now I'm in trouble. So I think that you sharing your journey and your experience is really, really pertinent to people, because one of the difficult things, and this is the same thing in the military, is the saying slow is smooth, smooth is fast. When you're doing a lot of like very fine detailed movements, high motor movements, and you try to do them really fast, it inevitably is slower every single time. And the reason is because when you're under stress, you lose a lot of those minor control movements and you kind of default to these big, gross, overarching movements that make it difficult. What I'm specifically thinking of is something like attack reload. So you're firing your rifle, you need to change your mag. If you try to do that as fast as you humanly can, and that's your mindset, you're probably going to miss the mag release. You're probably not going to smoothly fit the new magazine in. You're not going to seed it all the way, right? Like there's all these little things that start to fall apart because we're trying to move too fast. And the funny part about that is somebody can look like they're moving at the speed of light, but they will perform slower than the person who looks like they're moving in slow motion. But everything is super smooth, so it comes together beautifully. It's the same thing with trading. And a lot of people, unlike you, aren't willing to paper trade for any duration before. I'm actually curious how that went for you. When you first started paper trading, what was that experience like in terms of, were you wanting to paper trade? Was it something you were forcing yourself to? And then what did you learn over your time paper trading?
Yeah, definitely. I did want to paper trade mostly because I didn't have a lot to lose in the market and I had shorter amount of time. So I was working with limited capital and limited time. So my idea was before I get to doing what I really want to do, let me familiarize myself with what I'm doing, get those minor errors of entering the wrong order, wrong number of lots, clicking buy instead of sell, like all these different. It's so complex. We go through so many motions in just placing a single trade that if we don't inherently build the practice of doing it, we can introduce these mistakes while trading at scale. That's really what I wanted to take out. But more importantly than that, building the trade logs. I wanted to test the trade logs, right? I didn't know if these logs would work. So paper trading was the way for me to check the formulas. I would literally pause the screen on your video, pattern match exactly the color. Okay, the heading is black with white font. All the input cells are light green. All the output cells are gray and white. I'm just copying the exact thing. I mean, putting aside the shameless piracy, the amount of time it saved me in my own learning curve is is massive. I think it's paying. It got me much comfortable, much faster in engaging with the markets because it was like having a car that I could take out to a test drive on the real roads really quickly instead of worrying about building the car and still figuring out in the garage, you know. So that was most of my what my primary driver was for paper trading. And as far as experience goes, it was all over the place. Really just trying to understand what I was doing, if I was even doing it correctly, and just getting in the habit of collecting logs. I just coming to the desk and entering the trades, just building that habit, morning, evening, you know, whenever that. So that I think those things helped me without even me thinking through those things. They were helping me in the background. But yeah, it was mostly just trying to get the logs functioning so I could use it in real money.
Which is huge, right? And it's one of the reasons, and you know this, right? Everybody has always asked me like, hey, do you have a trade log I can download? And the answer is always the same. It's always been the same. It's no. And I have like the absolute bare bones skeletons of one with literally just words of the things that you're going to have to put in there somewhere and figure it out. But that process of building is really important. There's no scenario where at the end of building a trade log that works that you are now worse off than where you started. That's just the reality of it. You're going to understand just how these things interact better. And one of the things I think a lot about actually is efficiency in the workflow. I specifically set things up so that it literally mirrors my trade process, and the trade process is different depending on what it is. So sometimes it'll be date ticker, sometimes it'll be ticker date, and it is just completely built so that based on this specific thing that I'm doing, it is just as efficient as humanly possible to fill everything in. And that's actually the color coding that you picked up on. Like I specifically make input cells always light green. That's always light green, always. And it's so that regardless of where I'm looking at in the trade log, if I see a light green cell, I immediately know that's an input. I need to do something here. Whereas in the beginning, I didn't do anything like that. And then you find yourself having to look over your own trade log for a little bit to find stuff, and like super inefficient. One of the ways that I was able to like really pack my learning and make it super dense was thinking in ways like this. So that when I'm, for example, testing a strategy, if I'm spending an hour testing a strategy, 50 minutes of it is me actually testing versus having some subset of that duration where I'm just trying to find shit in my log because I don't know where it is, right? It's stuff like that really does add up over time. And I definitely am glad that you went through that exercise because everybody knows I am literally an evangelist for paper trading. I literally think everybody should do it. I still do it today. And still I paper trade. And it's just data. But again, that goes back to people being more comfortable embracing a process versus hoping the outcome of this one individual trade is going to pay for their car payment this month, and that's all they're hoping for. Fortunately, that doesn't work super well.
Yeah, and another thing I wanted to add about the trade log itself, I'm glad that you didn't give the formulas, although I was really frustrated at some points. I was wishing why you didn't just give it to me. But I realize now that when I move stuff around in the log and a formula breaks in a section, I'm actually able to fix it. I don't have to like ping you and hey, how do I fix that kind of thing, right? I don't think I would be able to do that if I had just downloaded that. You know, that's something really cool. I now know how to navigate that.
Yeah, and it's actually funny because in the very, very beginning, I actually had like an actual trade log that I gave to a few people, and I became tech support, and I was just like, oh hell no. Like if I'm sitting here like giving something that I took a long time to like build and refine, giving to you completely for free, and then I'm also supposed to help you troubleshoot that exact thing. I was like, that's not happening. So it's funny. You missed the boat on that because you might have had a completely done trade log, but there is no tech support.
That's funny. Cool. I think we're halfway through. So I'll introduce the topic.
Yeah.
I think I'll give a bit of a primer of why I came to the conclusion of bringing this as the first topic.
Sure.
It actually ties back into what we were talking earlier, is when all of us as new entrants into the world of market trading, investing, what have you, it's immediately obvious that this is something that we've never done before. It's a pursuit unlike any other. In school, we have teachers giving us lessons, homework. When we go home, do the homework, we get graded on it. We get extra lessons if we need to catch up or extra courses or whatever. Same thing happens at the job. We have our manager or whoever gives us a set of instructions. We take that instructions, apply the training that we have received for that job, output it, that either goes to the next person downstream or the next process downstream. These both conditions have defined boundaries, a set of rules. There's a structure, societal structure to all of these things. Trading is nothing like that. It's overwhelming when we come up on it. There's no rules, unboundness of it. So I personally felt really lost when I came up on it. So as usual, what most of us do when they get overwhelmed, we try to imitate the person who's doing the best in that, at least what we perceive as the best. So the day one will be, okay, this trader made X amount of money using Y strategy. I'm going to learn that. 1 week from later, another trader does Z amount of money with A strategy. Now I'm going to learn that. So I'm just jumping between strategies and watching different people do different things and just trying to emulate them. But I never considered if this is where my time should go, because I didn't know. I don't like, we just don't know what we don't know. That's why we have no idea of regime change. We have no idea of path. If the person that's posting it has any idea of what they're talking about, we don't know any of those things. So I wanted to bring this topic there, bring it back to the concept of optimizing market beta, and then the idea of main effort. So if you could walk us through what those mean individually, and perhaps why they're important, and how you can marry them together, particularly for beginner traders as they're starting their journey. Why it is important for them to focus most of the time on doing this. Why it could be important, right? So take it away from there.
Yeah, for sure. The funny thing before that you mentioned that really sticks out was the idea of like emulation. And something traders will come across is that trading, it really requires a different way of thinking. And a lot of people apply their standard day-to-day thinking to trading, which doesn't work well. This includes things like bargain buying. I use that example all the time, right? You try to buy stuff cheaper if you need socks. There's no reason to pay for socks. But if you do that, where I was literally just talking with somebody from the Discord this week that was like, how do you not be greedy on fills? Because they're putting an order at the mid and then they're not wanting to move it much, and then they just miss the trade entirely, right? And it's like there's a balance. If you overemphasize the wrong thing, you're optimizing for the wrong thing. But again, your brain isn't taught how to think more effectively in a trading environment versus your day-to-day. So specifically with the idea of emulation, again, in trading is also very, very difficult. I think it's easy to find things to emulate from people that are like good aspects. I definitely think you could do that. But trading is also really dangerous because people will try to emulate what they think a institutional trader does. And the funny thing is what an institutional trader is literally an entirely different game. You are emulating something that like quite literally is not relevant. There are elements of what an institutional trader does that are relevant, things like having a risk management plan and actually testing things before you move them to production and so on and so forth. So there's elements, but it's not the same. It's kind of like you or me trying to emulate LeBron James. Like, sure, we can emulate some of the moves he does, but I'm not as tall as he is. I don't think you are either, right? Like, there's just specific attributes that are just completely different, and that is what it is. So just on that point of emulation as a general thought, I don't think there's anything wrong with it, but I think you have to be super careful, super careful, because there's a really good chance that you're going to emulate things that actually can hurt you more than help you. Now, taking that to this idea of optimizing market beta and main effort strategies, the concept of optimizing market beta is if a trader was to start investing and that's it, what's the starting point? Typically, it's buying and holding an index ETF like SPY, VOO, hopefully saving aggressively, adding more to it each month, so dollar cost averaging, and come back 30 years later. That's what most people do by default. I think a big mistake that new traders make is going back to basketball. If I never touched a ball before and my near-term goal was to compete with LeBron James, it's not going to work. Like, there's no competition. If I've never touched a ball before and my goal for my first time playing basketball is to compete with LeBron James, that sounds fucking crazy. But the funny thing is traders do it all the time. Traders think that they're going to start trading and compete and outperform everybody, which some level of delusion I actually don't think is bad, right? You got to aim high. I don't hate that. But I do think that you have to have some parameters around it and have a healthy expectation of what's about to happen. So my position on that is a really good starting point for traders is to do what you would do otherwise and see if you can make it a little bit better, just a little bit better. One of the examples of this is actually on my website. I'll share my screen so that I can show you, because you can massively outperform the market without really doing anything special. And I think that part escapes a lot of people because they immediately want to go into and start seeing, how much money they can make super fast. So this, I think, is a good example. What this is a just example of 3 different portfolios. I have them labeled 1, 2, 3. And if we take a look at portfolio 3, it has a 8.6% average return, quite high. And if we compare that against portfolio 1, which only has a 7.4% average return, we would objectively say portfolio 3 has a better average return than portfolio 1. Yet, at the end of a 5-year period, it made less money than something that has a lower average return. This confuses a lot of people, and it's something that they don't appreciate. To further the point, if we take a look at portfolio 1, the best return that it had in any of the years was 10%. That's the best. The worst positive performance in portfolio 3 is positive 12%. So the worst positive performance is better than the best performance in portfolio 1. The only difference between portfolio 1 and portfolio 3 is portfolio 3 had a drawdown of 25% 1 year. It came out of the gate 30% return, 3 times that of the other portfolio. What's going on here? This drawdown completely screwed portfolio 3. They're now underperforming fairly to something that really didn't do anything that's special. 3 10% years, a 5, and a 2. The way that this applies to something like optimizing market beta is this. If we take a look at S&P and we look at S&P over a long time frame, 5 years. If we think about the way that S&P performs long term, it does well, it goes up. If you do something as simple as a basic momentum following approach, where if a weekly candle drops below some sort of set moving average, so it's a really slow thing, what you do is you cut off these big dips that you don't have to get some sort of positive return through, or you can flag them as periods where you want a dollar cost average in more aggressively, however you want to set it up. The point, though, is that by taking something as simple as what you would do anyways, dollar cost average into an index ETF, and you find really, really small ways to just make that a little bit better. That is a perfect starting point. And for those that don't know, my position is that like your first 2 years of trading, your goal should just be make more than $0. Just try to be positive. Like that is more than enough of a goal for your first 2 years of trading. It's not pacing the market. It's not beating the market. It's just try to not lose your money and get some experience. Then you can start looking at stuff like this, which is very realistic. This is way more realistic for people than their ability to intraday trade supply and demand imbalances in a super large index that has so much going on that they don't know, and they're just hoping that they can interface with it. That's not to say it can't be done. It can, and I know people that do it, but it is super, super difficult, very hard. This is way easier. So to summarize all of that, the idea of optimizing market beta is to aim low enough so that you actually have a chance of being successful. And then you can kind of parlay those wins and that success to then get better and better, hopefully. Now, the idea behind a main effort strategy in the military, we use main effort and supporting effort. Main effort is what we refer to as your bid for success. It's kind of like the thing that you think you're going to do to get the job done. And then you have supporting efforts that help the main effort do its job. In trading now, I think, as you pointed out earlier, traders struggle way more with too much information overload. So the point of a main effort strategy that might be based on something like optimizing market beta is to give focus. It's to give a good objective that ultimately shouldn't hurt you even if you fuck it up, because you're essentially doing what you would do anyways. Dollar cost average into an index ETF and try to find ways to make it better. You can underperform, right? Like you could only sell cash secured puts and never participate in the upside. You absolutely can underperform. But the probability of you blowing up your accounts trading a covered strangle in an index ETF would effectively require whatever index you're trading to blow up. So if you're trading something like S&P, it would require the S&P 500 to blow up. Not super high probability, but this calls back to what you were talking about before and the concept I shared in terms of slow is smooth, smooth is fast. Most people, they hear a good target for your first 2 years is to be greater than zero, and they think, oh no, I don't have time for that. And then they think like, oh, well, if I'm only going to try to like slightly outperform the market, why even bother? Not realizing that if you ever so slightly outperform the market for a sufficient duration, you absolutely smash it. But again, people are aiming higher than they can even see. So the purpose for that is to try and help people find structure so that that urge to move around, to bounce around goes away. The main reason why traders bounce around is when they're not confident in what they're doing and if what they're doing works. One of the cool things is when you know what you're doing works, that itch to bounce around effectively goes away because you know what you're doing is working. So sure, you might test that new idea you came across with a small amount of money and see if there's something there. Sure, that's totally cool. But you're not like completely pivoting your portfolio every time you come across something new. So to summarize everything, optimizing market beta, I think, is a great starting point for people because it takes the base case for what most people would do anyways, and it tries to make it a little bit better. Main effort strategy is designed to give somebody focus so that we're not bouncing around incessantly and making essentially no progress. You have to give things a fair shake in order to see if there's something behind it, and you have to go through path. So yeah, that's kind of like my Cliff Notes version for both of those, but happy to dive into any specifics.
No, that was great. I think you answered all of it, and you made a really interesting point about the itch going away once you have that baseline level of understanding of what works for you. That is so true. It's similar to another thing you talk about, like having a good defense allows you to take opportunistic shot at offense. That's how I think about the main effort in covered triangle as a whole in the strategy. It's like all weather tires for me. It can withstand many different market regimes and conditions if you have a good plan around it. But it releases your time to focus on other speculative section because now you have a system that works in the background. So that itch about jumping around is really, really good. It really works.
And the funny thing about specifically something like the covered strangle too is like, I have this sample portfolio that I've been sharing with everybody, and like you can apply leverage to it, right? So I'm trading a covered strangle right now in TQQs. With that, I not only absolutely smash the same notional value performance in QQQ, but I do it with lower risk. That is really unintuitive to people because you think 3 times levered, more risk. But again, notice how I emphasize the same notional value. Because if I set it up where I'm trading $500,000, and in QQQ, if I wanted to trade $500,000 of QQQ, I got to use $500,000. But in something that's 3 times leveraged, I no longer have to use $500,000. I can literally use a third of it. And I can have the same notional exposure, lower dollar exposure out at a given point in time, which then allows better dollar cost average and scaling in. Now, not all that glitters is gold. There's a lot of nuance when you're trading a levered ETF, especially something like TQQs. There's volatility decay, which isn't like the demon that people think it is, but it is a thing and you have to be aware of it. But it's just an example of how something as simple and something as really low touch as a covered strangle can significantly drive performance, which it's funny because sometimes when I'm talking with people, they'll kind of be a little bit down about like what their return is and stuff like that. And then if they're trading a covered strangle, we'll look at that and it's almost always outperforming the benchmark. So the real sadness is then that there's not more money in that because, we're trying all these other things that aren't working as well. And they're like, damn, my overall portfolio isn't outperforming the market. But then when you look at the allocation for the covered strangle, it's typically beating the market, which is super ironic because then it almost gets taken for granted something that even if that is highly specialized in like everything that a trader does, that itself is worthwhile and absolutely can make a significant performance improvement long term. Now, you do have to be cautious of drag, right? Like if you're doing it in a regular taxable account, you do have to be thoughtful about how much you're trading and at what size and frequency, because now you have the additional overhead of taxes. So not only do you have to outperform a benchmark, but then you have to logically be able to say, I outperform the benchmark after this drag is added. If it's not the case, then again, it doesn't necessarily make as much sense if your goal is to outperform the benchmark, which isn't always the case. For some people, it's to have a higher performance than the benchmark over like a 5-year period as compared to any one individual year, which I actually think is a much better goal.
Great. That I think that covers it. To that point, I came across an interesting paper by Michael Guy. I think it was called Leverage for the Long
Leverage for
Run.
the long run. Yep.
Yeah, that talks about exactly what you said, like managing around moving averages. So yeah, if anyone's interested. I did have a question from Wolf of Wall Street. Oh, by the way, shout out to them and Productive, Lilat, and Ricky for forming a group, a trading group. And I was telling them the other day that when we started our group, it continues to pay dividends. I think of my group mates as friends, really.
Yeah.
And they're my intellectual partners. I bounce ideas off them, and I look forward to meeting them every Saturday. It's so much fun. So I think really congratulations for those guys and those lads. But they had a question here. They're working on understanding how to scope in um, different information and in alignment to profit mechanism. I think you addressed this slightly yesterday in the post pro stream. If you had any extra thoughts or additional thoughts for this one, you can go into that. But there's a second part to that question was, would you consider meme stock trading a profit mechanism? If so, what are some signals that you would be watching for in that area?
Yeah, I'll do the second one first because it's pretty easy. I do think you could consider like meme stocks a profit mechanism, but I do think you'd have to get a little more specific because, again, the way that I think about meme stocks is probably different than what a lot of those people infer them as. Like, you can have meme stocks that are literally just popular, have a bunch of memes about them, and don't do anything. But I think the real thing that I would look to trade in stuff like meme stocks is like short squeezes of different kinds. So stuff that's relevant to that is like short interest ratios, short interest as a percentage of float, days to cover. All of those matter. Then things like volume and volatility. All of those become highly relevant, along with like option trading activity for sure. Giving GameStop a shout out and my deep dive into GameStop over the last, year or so? I don't even know how long it's been now. But the way that I came across GameStop, like I've always been familiar with the stock, but I ended up catching part of Roaring Kitty's trades as he was placing them. And it came out on a scanner that I had no idea it was him, obviously, but I just saw this highly anomalous volume coming in. So then I ended up trading it, again, just in expecting some sort of sympathetic move of an informed trader. And turns out, it was him, and, then it opened up a whole other door. But like, that's a really good example of a meme stock that absolutely has a lot of volatility and movement. So I even trade a covered triangle now in GameStop. Part of that is just to support the community, but it's also because of the way that profit mechanism behaves. And I have uncapped profit potential, meaning my upside is not covered. And by design, it's because those things can blow off really, really fast. So I actually have controls for that specific strategy where if certain criteria are met, I actually just flatten any sort of short calls that exist at the time. I lighten the cash secured puts and I just accumulate more shares outright. Sometimes I'll add like kicker calls and stuff, but I always fear for liquidity when trying to trade those during a squeeze. So I think you're better off with the underlying in something like that specifically. So yeah, I definitely think that there's a profit mechanism there. I think you just have to be a little more specific though, with like, what is the actual piece that you're trying to target? Then zooming out a little bit more and thinking about like trying to figure out the metrics that are relevant for a profit mechanism. The way that I think about this is if I have anything that I trade. So do you have an example of a strategy or anything that we can use for an example? I just want it to be random. I want to pick something that I'm not familiar with.
Just a strangle, VRP strangle, 30 days, 60 days.
Yeah, got it. So somebody saw Tasty Trade and they see that selling strangles or straddles out 45 days, whatever, tends to make money. And that's where they want to start. Completely cool. You're starting with something that is supported at least by some level of data, and it gives you a starting point. So then the follow-on way that I would think about that is I would absolutely start a section in my trade plan about that. And I always start with an executive summary, which is just a word picture, a couple sentences of like what I think this thing is supposed to do. Then I have a section for like setup, management, AAR. And in there, I'm going to just qualitatively describe what the profit mechanism is. So in the case of the example that we're using here, it's variance risk premiums in indices, which is the propensity for implied volatility to trend over realized. And also that gets juiced up double time in indices because they tend to have put skew. Great. So the next part is if I think about those details and those traits, the next question I have is what information would let me make more money with this? What do I think would let me make more money with this? That becomes your list of metrics that you think are relevant. A great example of this is I was working with somebody that was trading zero DTEs. I trade zero DTEs, community knows. And they were tracking VIX when they were trading their zero DTEs. It's a logical starting point because they're trading zero DTEs and SPX, so they wanted to track volatility. However, if we think about that metric, does that metric VIX match what they're trading with respect to a profit mechanism, zero DTEs? Of course not, because VIX is 30-day forward vol, zero DTE is zero DTE. It's a completely different vol window. So then in that conversation, they were like, oh, what about 1-day VIX? Even still, much better, but still different. That's still a different thing than what you're trying to trade. So the way that that works, though, is that person started what they thought was logical. Then what you do is if you don't have somebody or some sort of resource that says like what I just walked through, right? Like, well, this doesn't work for that reason. You can figure it out on your own. How do you figure it out on your own? You track what you think is best, in this case, VIX. And then at the end of the month, you just run an analysis and you say, how informative is the VIX measurement on the P&L or some other metric relative to my strategy? And the funny thing is you will find that it's effectively not correlated, slightly positive correlation, but effectively null. That's exactly how you narrow down the features and the metrics that ultimately matter to a profit mechanism. The game there is you're going to track a lot of shit that doesn't matter. And everybody will view that as like wasted effort, but it's not. Because even if you track something that gives you a null, now you know this isn't relevant to this. That is still a data point. So that process, though, of brainstorming what we think is relevant, outlining briefly why we think it's relevant, finding a way to track it in a trade log, and then setting a cadence to evaluate it and see how much does it actually add. That's exactly how you dial in what's relevant to stuff. And you can always begin with accelerators, right? So if I wanted to trade variance risk premiums in indices, I'm going to go to SSRN and I'm going to ask BRP. I'm going to ask index risk premiums, and I'm going to see what existing research is there. And I'm going to see what features have they already identified matter, because a lot of that work has been done to give you a starting point. So you don't have to like just make it all up on your own, especially if you don't know. You should use references like SSRN. There's nuance with it. I wouldn't take it all at complete face value. But again, if you have no starting point, it's a good one. So that's the exact process that I would use to kind of narrow down the scope in terms of what metrics are relevant to the specific profit mechanism that I'm trading, and then to validate those metrics to make sure that they're actually doing something for me. I can't tell you how many times I've tracked something that ends up coming out of the log. because after a decent sample size, I note that it's not really helping me make more money. It's not helping me predict things. It's not helping me reduce volatility. So I don't just delete it. I have a section in my trade log that literally just has expired signals or metrics that I'm tracking, different data points. So then if for whatever reason, 5 years down the line, that idea comes back in my head, I can maybe revalidate it. I can see what I did before. Maybe there's a way for me to make it better, or I can see what it did before and be like, oh yeah, that's a bad idea. I remember now, that kind of thing. So yeah, that's it. It's like anything else. It's just process oriented. The more that you can build things that you can repeat them multiple times, the better off you're going to be in trading, because you have to do a lot of that a lot of times.
Great. Thank you. I think that wraps me up. Thank you for having me on. It was great chatting with you.
Absolutely beautiful. Super, super fun to catch up. And for those that are interested, essentially, we're going to plan to do these like once a month. And if you're in the Discord, it's free for everybody to join. If you have like a topic or something that you want to see us discuss and go into more detail, let Shreyj know. You can tag him in there, and then he can keep a pulse on it for you guys, and then we can hit it during one of these. So thanks for hanging out, Shreyj. Hope this is useful to everybody. Let us know if it was. Be an outlier. We'll see you guys later.